in this zone is where we are actually expecting to get triggered in and then move along with the big boys, right? So that is exactly what we're going to be demonstrating with. Welcome back to Day and Night Forex YouTube channel, and in this video we got some exciting knowledge that we're about to share with you. This knowledge is actually something that we're taking out of our new course, which is the Big Boys course. We dig deep into this topic on supply and demand and how to trade it like the big boys do. So not only do we go deeper in detail when it comes to supply and demand in the course, in the Big Boys course, but we also tackle a lot more deeper aspects of forex trading, such as psychology, patience, and discipline. You know, those are some of the key aspects that you need to understand in a much deeper way when it comes to trading forex successfully, right? When it comes to becoming a successful trader. And we also go deeper in detail and cover things such as when is the best time to execute, or when is the time to actually stay in the market, because it's not every day that you should be sitting behind your laptop looking at the charts, you know, looking for setups and everything, right? So you need to know when is the best time to execute and when is the time that you should just call it a day and stay away from the market. So those are some of the things that we go in deeper, in much more detail in the Big Boys course, and much more information that you need in order for you to tackle the market with a clearer mindset. So if you're interested in that, again, it's at dayandnightforex.co.za, and you can go get yourself enrolled for the Big Boys course, and then you'll be able to access all this information. So if you are interested in that, you can always just go and get a copy of yourself here on our website at Day and Night Forex as well, along with all our other services that we provide, right? So but in this video, as I said, we are talking about supply and demand and how you can make money trading supply and demand zones. Without wasting much of your time, let's get straight into it. So in general, you need to understand that when it comes to supply and demand, this is a concept that applies to anything and just about everything in life, right? So where there is increased supply, that means that it's easier to get that product or to get that service, right? So you don't need to put much effort, and hence in the market as well is the same, or in business. If the supply is increased, that means you can get the access to the product or service at a much cheaper rate than when the demand is high, right? So that is the same that happens in the market. When there's increased supply, we can expect the market to actually start falling, right? To start selling. We can expect the investors to start selling their positions and basically looking to get in a more premium demand price, right? So that is what we are going to be explaining in this video for you, with illustrations as well as market live, actually breaking down on the market charts as well. So stay tuned to actually see how we apply this knowledge onto the charts as well. The opposite applies when it comes to demand, right? When there's increased demand, it's basically hard to get your hands on that product or service, or otherwise the price will actually be increased, right? It will be expensive. That's when the product becomes expensive, because it's limited supply and people just want to get their hands on that product. So allowing people to sell it at a premium price than provide it at a lower price, right? So this concept applies in everything in life, allowing us to apply it in the markets as well, because remember, in the markets, it's actually real people moving these markets, right? So we may call them the big boys, but still behind that, there are actually people that are making these decisions in the markets, right? So that that's how the markets move every single day, right? So if a company wants to invest in South Africa, let's say they want to buy the South African rand, they have to come spend their dollars with us, right, in exchange for that rand, right? So it depends now how many countries or how many companies wants to invest in South Africa. That increases the supply and demand for the rand, and basically that affects the price. The more supply that we have of the rand, meaning that we don't have much investors interested in investing in this country, that means that the rand will actually be accessible to them at a lower rate. But when there is like a booming industry in South Africa, a lot of investors want to invest in our country, that means now the demand is up, right? So that will keep pushing the rand value higher. So that's basically just to explain the concept of supply and demand to you in a nutshell, right? So as I said, in our course we go deep into this, but that's basically what you need to know and understand when it comes to supply and demand. In the forex market, we basically have three trends: moving in an uptrend, we're moving in a downtrend, or we are consolidating, right? So what happens is when there's consolidation, that means we have an equal demand and supply in the market. There's no increased demand, there's no increased supply for the product. So basically it's just this is when we experience consolidation, when there's no really any major movement in the markets. So how does this really work? Well, the big boys, when they come in the market, they come with a lot of money, right? They place their orders at certain areas in the markets, and basically when they place their orders in these areas, basically they cannot have all their orders filled in just one go, right? So the market has to come back and then fill in all the orders that are still there. And how you notice this areas basically is market moves either if it's a supply zone, you see it by market dropping very fast with huge candles from that zone. That's how you determine that this is your supply zone. If it's in a demand zone, basically the market will buy from that point with the huge candles and then later on come back to fill in the rest of the orders that are left in that position, right? So depending on how the market moves from that position, it also shows you the amount of momentum or how much orders there are actually at that point, right? So the bigger the move, the more you can expect the market to actually come back and then again give you another move, right, on that market. So the best tip that we can give you is just to always be looking for new opportunities, new supply and demand areas, because once it's tested more than once, that means basically the orders are getting less and less, right? So the chances of it bouncing off from those supply or demand zones, but again, they decrease each time it comes back and bounce off, because it's basically just finishing the orders that have been set over there. Now, another tip that we can give you is to focus on the bigger time frames. So the H1, obviously a supply or demand zone on an H1 will have a stronger effect on the market than those on a lower time frame, the 1 minute time frame. It might be just some small orders that has been placed. So once the market comes back to retest it on that 1 minute, it might get liquidated and then it's out, right? All the orders are filled in and the market has no interest in coming back into that 1 minute supply or demand zone. So the bigger the time frame, the stronger the zones will be. And again, I will repeat, always look for those zones that the market has not tapped into as yet. Those have the more potential of the market actually coming back to test them again. Now let me just go to some visuals that we can present to you. Just using TradingView right here. We are on a Nasdaq 5-minute chart over here, but we're not looking at the chart as of now. I just wanted to show you how these demand zones actually form, right? So how do they form? And basically this is how this demand zone forms. As you can see over here, we have a nice illustration of a demand zone and how it forms. So I'm just going to grab my paint brush here, and basically what we can see right here, we have a move. We are talking about the demand zone right now, right? So we have a move up and then we have it right over here, right? So this is the area where the big boys have placed their order. We're now expecting the market to come back and basically retest the same area. It might not come exactly to the same point, but it's a zone, right? We call them supply and demand zones, not basically to a T like support and resistance where you have an exact number. This is a zone, so the market can come back in the zone, and then we're going to be showing you how to draw those zones so that you don't miss out on the entries. So just stick around for that. But basically we are looking into the zones, right? So basically the market takes off with their orders over here, but then not all orders will be filled over here. And we remember what we said about this. We see these zones by the huge candles that move away from this zone. So they pretty much do it very quickly, right? So they usually like 2-3 bullish candles from that zone. That shows you that this is a serious demand zone, right, that you need to look at, right? So once you upload this demand zone, you'll basically be looking for an entry over here, right? So maybe this is an hour's chart. When the market comes back into this zone, we're now going to our entry time frames, which will be the minutes and the 5 minutes, so that you can see how the market structure is playing out in that zone. So when you get, maybe it's a W formation, it's a head and shoulders on a 1 minute, then that is how you'll be able to capture those sniper entries at these zones, right? Just based on a higher time frame supply or demand zone. Now looking at the supply zone is basically just the opposite of demand zone, right? So the of course, when it comes to the supply zone, we are looking into selling, right? We're looking to sell when the market creates those lower highs, right? So this basically we have a lower low over here. Remember, the market, when it moves in, when it is going in a downtrend, it creates a lower low as well as a lower high, and then comes back to break the previous lower low, creating another lower low, and then comes back to create a lower high, right? So when it comes back to create this lower high here, that is where we are looking for entries into the zone, supply zone that has been created over here. Once again, we see this supply zone by the huge candles that move away from those zones that we are seeing, right? From where the market has created that lower high, that is where we are looking to get our entries and join the big boys, right? So when we let the big boys or the market makers make their moves first, then we follow in the direction that they're making, right? We don't lead the market, we always follow what the big boys are doing. That is the best way to trade. So a supply zone, we find it in between two lower lows, right? So this will be our lower low and then another new lower low, and this is our lower high over here, and that is basically where we find our supply zone, right? So that is where we are expecting the market to actually come back to tap in that zone. So remember, we said it's a zone, right? So it doesn't have necessarily come back to the tip over here, but basically is this whole zone that we're looking at, which basically we are looking to get our entries from zones and not exact points on the markets, right? So you have to keep that in mind because it's very, very important. Now I'm just going to take a look. Now we're just going to move on to a chart here, which I just plotted some of these zones so that you can see how effective they are and how basically we plot them, right? So right now we are on the H1 for US 30, which is basically the same, almost the same as Nasdaq, NAS 100 over here. So some of these moves, you see that they actually there are days where these markets move in the same direction because they're basically almost the same, right? So what we're going to do is just take a look at these supply demand zones that I've plotted over here so you can take a look at how to draw them and how to plot them, right? So basically they just start from here going backwards, right? Yeah, let's start from here going backwards. So when it comes to drawing the supply and demand zones, there are two ways to do it, right? So the first one is basically we are looking at the weeks, right? So as you can see this week over here, in most cases in this bullish market that we're seeing right now, a week to the bottom will either be a bullish engulfing candle or maybe it's a head and shoulder or a W formation, right? Just depends on what the time frame you are looking, lower to that time frame on the higher time frame, right? So it's just like it's a sign to show us that the market failed to break or to close at that lower price. That is the first thing that we need, that we look at. So basically the wicks is what we'll be looking at. And then the second one, so let's say we are in a demand zone, we are looking for a demand zone, right? So remember we said when it comes to the demand zone, we'll find it in between the two higher highs, right? So when the market moves high and then comes back and then makes another high over there, we are looking into this point over here, which will be our demand zone, right? So that is where we are looking at over there. We're looking for the market to actually come back and then give us an entry in that zone over there. So that is where we will be looking for a demand zone over there in this area like that. When you are looking for a demand zone, for you to plot this block over here where you're expecting the market to look at, we are looking at the last bearish candle, higher high to make a new higher high. That is where you're looking to plot your block, right? So right now we are going to take a look at an example of a demand zone. So as you can see, we just drawn our block over here at the bottom, right? So as you can see, we have a couple touches on this block right here. And remember at the start, we also talk about the aspects of trading that you need to have, and patience is one of them, as well as discipline, right? Which is something that we said we cover in the course, right? But right now, this is an example of where patience actually really pays off, right? So as you can see, so we had a couple entries in these trades over here, and we were only able to capture it on the third move over here. That's, as you can see, that is when it actually like took off and then made the biggest move. That's when it actually started, right? But basically the first two entries, we made our entries and then we're trailing our stops. We're trailing our stop loss. If you're part of our students or you're part of our signal groups, you already know that we don't really trade using take profits. We like to trail our stops so that we can capture the whole move, right? All the way, right? So as you can see here, we are only able to capture on the third move. So why did we actually come back and we re-enter this every time that the market came back to retest our zone? Why did we enter another trade? Basically the reason for that was that on the 15-minute we actually have a nice W formation, which was on the 15-minute chart, right? So that is why we entered more trades, right? So it's just about patience, discipline, and then following your rules, right? So the W at the lows of the day, I think you know that part of the day and night strategy, right? So that is just a quick explanation of what was happening here, right? So basically support and demand zones are more powerful when you couple them together with W formations on a supply zone as well as M formations on a demand zone, right? So it's just like extra confirmations, which basically like gives you a higher chances or higher possibility of your setup actually working out, right? So to just expand on that, we have a couple examples that we have here from the trades that we actually took. So as you can see, these are some of the screenshots from January, as well as the other one over here that we're going to cover, which is just a recent week from February, right? So that was basically last week, right? So we're just going to take a look at these and then show you exactly how the markets basically work, right? So as you can see, some of these zones that we had here that we took. If I grab my paintbrush over here, as you can see with this moves over here, we had our W formation, right, as well as our zone on H1. So there was a zone on H1 which is around this place over here, right? So basically that is where we took our trade from this zone that was on the H1. We took our trade. We had a W formation on the same setup as well. As you can see, we pushed up all the way, and then we were just taking more trades, right, as the market goes. And then when it came back, we just take more trades because we are seeing the W formation, right? It's just an extra confirmations, and we're already moving away from a supply zone that we had here on the H1, right? So in this case, as you can see, it actually played out and we were able to capture the whole move, right? So right here, as you can see, this is on M1 time frame. And then if you can take a look, an example of demand zone here on Nasdaq, as you can see right here, we basically had our demand zone on H1 again, and then now we dropped to M15 to just see more of this setup in a clearer way. As you can see, we also have an M formation right here, double top, if you want to call it, as most people call it. But basically, as you can see, what happened in this is basically still it's just the opposite of the supply zone with the W, but now we're looking to sell from the demand zone going down, right? So as you can see, we had our first touch over here, and then our second touch over here, right? So when we entered this is actually a bit more risky, but we also had some negative fundamentals on this day. As you can see, that's why we later on had this huge candle that just sold off later on, but basically we just held the trades, and then when it came down, created a small W formation there, and then we came back to create the second leg over there. And then that's when we knew that, as you can see with these spikes, the spikes basically just showed us the loss of momentum, right? There was no more momentum, meaning that the buyers were now exhausting, right? So as you can see, the spikes that are there, let me zoom in for you a little bit. As you can see, the spikes that are there creating the second leg of the M formation, right? So that just gave us extra confirmation that the market was about to tank, right? As you can see, together with the negative fundamentals that we mentioned earlier on. And then boom, the market came and just fell just like that, right? As you can see over there, and we ate. And that was another successful day, looking using the demand zones together with the double top or the M formation. So it's just more powerful when you put it together like that. So if you can just take a look at it, the last example that we have here, we actually traded the same on VIX 75, as you can see right here. This is on M1. We basically had a setup on M1. We had a zone over here, right? And as you can see, we have our W formation over here. So in the course, we also covered the different types of W formations, right? So you won't always have like the perfect W formation, right? So maybe it won't be exactly always like leveled at the bottom, right? So sometimes you get it with a lower leg, or you get it with a higher leg, right? So in this case, we actually had one that looks something like that, right? So with a leg that is higher than the first one, but still we are looking at our W formations, right? And we had our supply zone as well, and that basically just together gives us more confirmations, and then we are able to capture these trades as well, as you can see. So that just allowed us to actually capture these trades as well, as you can see right here, and basically we killed it, right, on the M1, but the zone was on the M15 or H1 for this setup over here. So as I said, we go down to this lower time frame to actually find those perfect entries, right, so that you can get in at the best prices when you get that extra confirmation, right? Like for example, in this case, the W formations which we're saying, the W and the M formations that go very well together with this zone. So be always on the lookout for these W formations and M formations when you're trading with the supply and demand zones. If I can just take a look at another example over here. Right now we just looked at a demand zone. Now let's look at a supply zone example. So all right, so in terms of the supply zone, basically what we're looking at, as you can see, I'm just going to go through this example over here, right? So what we are looking at is basically when the market comes back into this zone over here. So basically remember, we have a lower low, right? And then we have a new lower low, right? So in between those two, this lower high over here is where our supply zone is going to be created, right? So we'll be looking at, remember now we are looking for a supply zone, so we're looking at the last bullish candle. That is what will give us our supply zone, right? So with this example over here, so now it's not always that you need to refine your entries. We could have used this candle over here. It's also a nice one, but as you can see, the candles that moved away from there, they were not very decisive in the direction compared to these ones that you're seeing over here, right? So this entry over here could have also worked. I mean, if you can just take a look at it to see how much we could have been able to make. I mean, if you make the entry at this lowest point of this candle, remember now we are selling, so we're looking at the lowest point and not at the highest point, right? We look at the highest point for entries when we are buying, at the lowest point of the candle when we are selling, and then at the highest point of the candle when you're buying, right? So you just need to keep that in mind as well. So right now, as you can see over here, and remember we said we always give some room for the market to breathe over here. So if you put it right on top, you'll basically be kicked out, right? But if you give it some room to breathe, maybe 5-10 pips above that candle, above the highest point, as you can see over here, and then we'll be targeting the previous lows where the market had started, right? So our entry will be somewhere here, and then we'll be targeting these lows for our first TP, right? But remember, when the market is in that trend, we are expecting the market to break through those recent lower lows or those recent high highs, right? So in this case, the market actually did break through that, and then came a bit lower than that. But here, that was in 1:3, 1:1.3, which is not very good. Remember, we're aiming at least for a 1:2, 1:3 as our risk to reward ratio, right? So in this case, this would have been the best. This would have been a best TP over here to get out of there. But anyways, we did not take that trade over there because we're not too convinced with these candles over here. The momentum was not enough to convince us to actually take the trade, right? So we went on and waited for this one over here, and basically, as you can see, we had this candle. We just refined for 15 minutes, but it's not really necessary looking at this sides of this candle, right? So basically, if we can just take a look at this candle and then reset our entry back to this position, even if we just reset it without any refining, right? So that entry that you saw there is actually after refining this candle on the 15-minute chart, right? But right now, just staying with this candle, the H1, basically, as you can see, we could have been able to get a trigger right over there, and our first TP will be the previous lower low right over here. So if you can just pull back our TP to this point right here, we'll be looking at a nice 1:3.66, so almost 1:4 over here, 1:3, which is not too bad, right? But as you can see, the market, if you were able to actually hold this trade for longer than that, you could have been able to capture 1:5, 1:6, but the most that it went all the way down to the bottom over there. In this case, you would know maybe we are having our upper trend line, at this point over here, and basically what will happen is we're expecting the market to do the same on the downside, right? So on the downside, we would expect the market to give us a similar move, and basically that would, give you that position right there at the bottom, right? So okay, so now that we have shared with you all the information that you actually need in order to make some money trading the supply and demand zones, as well as putting it together with the M and W formations, as we said, they work actually way better together. Right now, we're just going to share with you a few more tips that you need in order to actually make it in this industry, right? So a lot of traders run after every new strategy that they hear about, but never focus on letting go of emotions and fear. And these two actually play a huge role in Forex journey. It will play a huge role in your Forex journey, because Forex will deal with you to an extent of you being afraid to even execute the smallest lot size in the market. You'll be so scared to enter any trades because you don't want to lose money again. And we don't blame traders running to the next strategy, because market conditions are forever changing, right? It's a forever changing industry, and even the best traders will have to evolve with the market if they still want to make profits, right? So most traders actually don't adapt to the new market conditions, and that is why they end up taking profits way too soon. And also on the negative side, they actually cut losses late because they're not adapting to the market. They're using their outdated strategies that don't apply to the current market anymore, right? So you have to adapt to the market as well, right? Now, one thing that I've noticed among a lot of traders, that some of you don't even know yourselves. You have to find yourself first, because you can have all the knowledge that the next trader have that who is making money, but then you yourself still don't make profits like how they are doing it. And this can be caused by a small difference in personality, and this is the reason why you need to know yourself first. And in Forex, one problem leads to another. So for example, you might be a person that gets excited over wins and you get angry over your losses, meaning you're a sore loser and you don't take losses very well, while the next trader treats wins and losses the same. No reaction at all, just another bad day at the office, and basically just close the charts and go for a run or something like that, right? You, in comparison to them, you stay stuck behind your screen and reverse trading, trying to recover your losses, right? So this is the difference between winning winners and losers, right? So such small difference in personality basically can just ruin yourself when it comes to becoming a successful forex trader. After that comes increasing the lot size and trading setups that are not even part of your strategy, just to revenge trading, right? Out of emotional reaction to the market. Can you see where I'm going with this when I say one problem leads to the next one? Because this whole sequence here just started with someone reacting with anger to their losses, and basically you end up revenge trading, possibly blowing your whole account. And as soon as you know it, it becomes a pattern where you break all your rules, all your trading rules. Therefore, it is very key to figure out first if you have a problem with the method that you're using, your strategy, or if you're having a psychological problem before you actually take action on this. But first of all, you must identify your problem and become aware of the cycle that you are looped in, and then make changes to break out of it. You have to realize your problem first, identify it, and then try to break out of it. Maybe, for example, your problem is overtrading. Then you have to recognize why you are overtrading. Maybe it's because of boredom, or maybe there is something you want to buy and you need money fast, or you have nothing to do during that time but to sit at home all day and press buy and sell on the market, right? So you have to recognize your problem, analyze what is going around it, what is causing you to do these things, and then try to tackle it from there. So after recognizing the problem that you have, then the next thing is basically you have to find a way to control your problem. For example, if you trade because you are bored, basically you just need to find a hobby or something to replace those few hours that you're spending in front of your charts looking at dead movements like you're watching a horror movie.
Damn, son, where'd you find this?
Anyways, if you are a swing trader, there's no need for you to be in front of your charts whole day. And even if you're a scalper like us, because we're also scalping, there's no need for you to stay stuck watching the market the whole day. Yes, we may miss some setups, but the ones that we catch make up for all the others that we may have missed. The way we do it here day and night, we basically just only look at the charts when it's New York session, and basically that's at 3:30 or 4:30 South African time, and that's basically the move that we are aiming to catch. After that, we are done with the market for the day. There are times when we will trade setups in the London session if the move is actually clear, but we prefer volatile markets, which we find in the New York session. We take our profits or losses, then we continue the next day. That's it for the day. That is why we have more wins than losses, because we stay disciplined, right? We don't react to our losses, and neither do we over celebrate our wins as well. The market is forever changing in its volatility as well as the trend, so you need to get rid of this mentality of saying Nasdaq is always a buy. The strategies that are dominating the market now are not the same strategies that dominated the market 10 years ago, right? Successful traders are always studying the market and adapting to the new changes. The easiest way to spot market changes is in your strategy. If the same method that you use gave you more wins than losses in the past, and now the same rules that you're following are giving you a loss after loss, then you know that it's time for you to adapt to the market changes, and you need to look back into your strategy and see what you can change to adapt to the new market conditions. That is why trading robots that gave you good returns in the past are now blowing accounts, because the strategy the developers coded back then, which worked back then, they are now outdated and don't adapt to the new market conditions. So now what most of these mentors do, they simply just rename the robot and sell it again, selling the same old robots that have not been upgraded to trade the new current market conditions. That's why a lot of their clients are blowing accounts, because of the big drawdowns from these EAs, which they didn't even code themselves. The only reason why they are making money is because they fund with big amounts, and they don't even warn clients that the robot doesn't accommodate small accounts because of the deep drawdowns, which will blow their small accounts before making the profits. So now they only show their results to the public and block those complaining clients. So this industry is actually quite deep. All of us traders have different strengths. That is why no trader will ever be like the next trader. Each and every single trader is strong in some areas. It might be focus, it might be discipline, maybe tracking fast moves, spotting those entries without even analyzing the markets, or whatever the case may be. But each of us as traders, we are good at something that maybe the other trader might not be good at. For example, myself, I'm a day trader, basically a scalper, and I track moves very fast. My mind works fast, and my eyes now are able to see patterns that have not even formed yet whilst they're still in the process. I also process real-time information very quickly, and I execute scalp signals on the M15 instantly. So when it comes to quick decisions, bank trader is your guy. And then you get those traders that behave like investors. They take decisions slowly and analyze every time frame before making that decision. They are more focused on long moves that they catch on those bigger time frames. They think deep and go into depth in different areas, spotting information that other traders didn't see. So that's their strength compared to other traders. Again, we all have different strength when it comes to this forex industry, and it is key for you to figure out what is your strength. So once you have figured out yourself, the next thing is actually to be a bit more creative, because if we all trade the same way as everyone else is trading, we'll all get the same results. You won't be able to stand out of the crowd, right? So creativity is actually key. So simply adjust that strategy until it works better for you than any other people. Be more creative with the strategy, right? Make it work for you specifically. That's it for now from us, guys. Make sure you like the video, leave a comment down below, subscribe to the channel so that you don't miss out on the next videos. Trust me, this year we got a lot coming forth for you on this channel, so make sure you subscribed and you got your notifications turned on so that as soon as we drop a new video, you'll be the first one to see it.